I'm David Walsh. The founder and CEO of CIM. On behalf of the whole CIM team, I'd like to welcome you to today's webinar. So firstly, I'd like to do the acknowledgement of country. I'd like to respectfully acknowledge the traditional custodians of the land on which our panelists and our attendees meet, and recognize that these have always been lands where learning has taken place by storytelling and through the sharing of experiences. We pay our respect to their elders past, present, and emerging. Now, a quick intro to today's topic and panel. Today's discussion is all about gleaning insights from past experience and historical trends to inform decision-making today and into the future. So it's easy to follow. We frame the discussion in three parts: the past, present, and future. Joining me on the panel are three well-recognized senior leaders of the Australian property sector, all with extensive C-suite and board-level experience. By way of introductions, please welcome me in joining Tanya Cox. Tanya is an experienced chair and non-executive director of listed and unlisted high-growth property, technology, and sustainability boards. Some highlights from Tanya's impressive suite of current positions include member of Chief Executive Women, chair of Australian Sustainable Built Environment Council, non-executive director for Cromwell Property Group, and chair of Equim. Formerly, Tanya was the chair of the World Green Building Council and chief operating officer for Dexus. Paul Say. Paul has over 40 years experience in commercial and residential asset management, development, and real estate broking with major multinational institutions. Paul has held various independent non-executive director roles for the likes of GPT, Frasers, and Leighton Holdings. Paul was previously chief investment officer at Dexus, and prior to that was head of corporate finance with Lendlease. At present, Paul is a non-executive director for the Mirvac Wholesale Office Fund, Cedar Woods Property Group, and the not-for-profit group Women's Community Shelters. Mark Steinert. Mark has more than 30 years experience in property and financial services, most recent as the managing director and CEO of Stockland for 8.5 years until 2021. Mark has held various roles with UBS Investment Bank in Australia and the US, including Global Head of Real Estate Research and Group Managing Director. Mark was also formerly a principal at JLL and president of the Property Council of Australia. So now some housekeeping. As you're watching and listening, please feel free to ask any questions of our panel using the Q&A function. If your question is for someone specific, please make that clear in your question. If we run out of time, we will log your question and be sure to respond to them following the webinar. Once the webinar concludes, complete the short feedback survey and keep an eye out for a link to the recording in your email inbox. So, looking back, our macro environment and today's macro environment is undoubtedly challenging and uncertain. But there have been times in the years gone by when conditions were also volatile. So a question to the whole panel. Can each of you talk us through a period in your careers where your firm was confronted with a difficult macro environment, or perhaps a time when a major disruption forced you to strategically adapt or pivot? And what did you do to counter and overcome it? So I'll maybe hand that one to Paul.
Thanks, David. Hello, everybody. It's probably, well, I guess first I'll sort of expose myself as a cycle disciple. Typically property cycles run in sort of 8 years, and generally the sort of economic booms and busts. And in my time, probably since I was paying attention, was probably the early 90s downturn for the property sector. Then there was sort of a glitch, which was late 90s, which was the Asia crisis, and then dot-com crisis, early 2000s, and then the one that probably, one that everybody's aware of, which is the sort of GFC, which ran through there. So They were all very difficult periods where we saw primarily uncertainty, driven by sentiment and interest rate changes to a certain extent. So each of those patches were very difficult in my career and for the different organisations I was in. In terms of adapting, I think all you can do is just, well, my view is you've got to acknowledge that there are going to be those cycles, which has been a bit difficult this last phase because we've had an extended cycle due to, my view, quantitative easing and the central banks really trying to avoid the correction that we might be experiencing now.
Okay. And Mark?
Yeah, thanks, David. Hi, everyone. I guess, like Paul, I've sort of lived through all those fun and games. I think, his point's very valid. And for me, the global financial crisis, was the most challenging of them all. I think at the moment, what we're going through is pretty tame compared to that. The degree of adjustment, uncertainty, and the requirement to rapidly cut costs and reshape was quite terrifying, really. I was with UBS in New York at the time, so I remember walking home past the Bear Stearns and Lehman employees, and that was a pretty shocking experience, to be honest. And sort of going through all that, I think looking at price cycles and data points is critical. And there was clear parallels to the 1930s depression. I think the only reason there wasn't a depression was the magnitude of central bank actions and social security, when you boil it down, and the limitations around bank failures that helped stimmy emergency lines of credit and the fiscal stimulus and social security payments. Ultimately, for us at the time, doing more with less and having the confidence, like Paul said, that the downside, was limited by central bank action, and then an upcycle would ultimately emerge from the ashes. We aggressively reallocated resources to align with what was a radical change in customer demand and selectively invested ahead of the actual upturn in the broader economy, and that position is extremely well, both in terms of opportunities, but also in terms of customers and helping them to navigate the situation at the same time.
Thanks, Mark. Tanya?
Thanks, David. Look, I completely refuse to acknowledge that I might have been around for the same 4 decades. It feels like it's way too many cycles. So I'm going back to the most recent one. And I was just picking out something that was really specific, sort of just to help the audience get an idea about how we felt about things. Back in the GFC, which of course was not a traditional recession, it was basically a credit crisis, and so cash was absolutely precious. All of the REITs had multi-billion-dollar debt books at the time, and the banks, of course, were looking to basically have the loans repaid. In 2009, to sort of compound the problem, the federal government actually stomped out and said, by 2013, it will not occupy any assets unless the assets are a minimum of 4.5 stars. And, what that meant was that REITs really all of a sudden needed to find tens of millions of dollars of additional capital to pour into these capital works that of course, at the time were unbudgeted. So the government hadn't done us any favours, but they're a huge tenant. And so all the REITs were basically in the same bucket. And, asking what we did about it, well, of course, being a property company and needing liquidity, really the only option, at the time, the only option that we had in front of us was to actually sell assets, which is a tragedy, if you're a property company, particularly selling an asset at the bottom of the market. But, the reality was that it was one asset, and as painful as it was, we sold the asset and we moved on. But I think the moral of the story is that it's incredibly costly not to, not to continue to look forward. So even though things are looking horrendous at the moment, if we look far enough forward, we're basically, going to keep ourselves out of that sort of trouble. There was lots of signs at the time that, sustainability energy efficiency was going to be important, we probably could have actually, got a bit ahead of the game, but we didn't. And I think that's the lesson, and I think that lesson's about to repeat itself. So I'll save that up for a bit later.
Yeah, but just to kind of pick at that sustainability trend or thread, like there's no question now that sustainability has become a business critical priority for all the REIT boardrooms, but it wasn't always like that. And like Tanya, in those early days when sustainability was less spoken about, like how did you get it onto the boardroom agenda, and what challenges were you met with, and how did you kind of focus on its importance?
So you're right, David, it wasn't on the agenda in the early 2000s. I mean, the Green Building Council had been established, the World Green Building Council had been established, but the reality is I think it was enthusiastic executives who were basically taking the steps and, and driving, based on financial imperatives, they were really driving the action. So, for instance, adopting LED lighting was sort of cheap and easy and affordable. And so those sorts of initiatives were underway, but it hadn't actually, mainstream, hit hard on the agendas until, of course, this, 2009, government statement. And I'm talking generically, there were a couple of REITs that were way ahead of the game, but most of us were in the pack. In 2009, following the government's announcement, we needed real money, serious money for big initiatives around, HVAC upgrades and lift upgrades and things. And so I think that the REIT boards, all of them, ended up with sustainability on the agenda because there was serious money that needed to be spent. So I'm blaming the government for putting it on the agenda. And if we've got just one more minute, I think that I've got a feeling that history is just about to repeat itself, because most of us would have heard that Chris Bowen, the Minister for Climate Change and Energy, just last month actually came out and announced that the government was developing 6 sectorial plans to, including one for the built environment. So there's one just for us, which is actually going to lay out the pathway to net zero, so that each sector is actually able to clearly sort of see what it has to do and where it has to be by 2030 to meet the government's 2030 targets and inform their 35 targets. So it's not clear what the plans are going to include, but they could include initiatives like national energy performance targets and different sorts of quite high hurdles. So it is quite likely that when the plan comes out in September or October, for each sector, there's going to be another round of these unplanned capital expenditure demands that that we are all going to have to find a way to deliver on.
Yeah, and Paul, in relation then to that kind of investment decision making, what over the years, how has sustainability formed or changed that process?
Yeah, I've been non-exec now for 12 years, so a little bit out of the mainstream, but and to TC's point, what's different now is that it's not just government that's driving that initiative. So we're seeing investors either voting with their capital, saying, look, we'll only go into institutions that have got net zero and sustainability strategies, or if they're already existing investors, then they're demanding components of balanced score sheets and executive targets for bonuses. And then the latest one is the big drive for the tenants. So there's those big corporations, government and non-government, are seeing that they need, or they can see part of the property move, or the property move as part of their sustainability initiative, and can score well there. But there's still two camps. I sort of live in both worlds, the institutional world's there, and there's a lot of progress being made. But there's still a lot of capital, private capital, quite happy with sort of B-grade buildings. They're either greenwashing or just ignoring it, and that's a concern.
And Mark, how would you characterize then the connection between the sustainability and shareholder returns, and how has that changed over the years?
Yeah, look, I think it's integral, and that, I guess, integral view really is that sustainability is absolutely tied to the concept of a circular economy. I think circular economies will become, the absolute norm into the future, and with a diminishing resource base and all the issues that are well documented around climate change and around ESG, more broadly social, community requirements, shareholder requirements. Now they're all kind of converging, and I would say the pace of that has accelerated, as Tanya and Paul described. And when you think that built forms 1/3 of global energy consumption, there's no way it's not going to be, in the targets of everybody for action. Although, as Paul said, there's still varying views. I think the recent, greenwashing issues and the emerging regulation, as Tanya touched on, is going to, really drive an acute focus. It's going to move from a pretty strong focus to an acute focus and a more realistic and genuine focus, I'll say as well, towards a pathway, a real pathway to carbon neutrality. And, that's going to drive a lot of innovation, a lot of strategic initiatives. The idea of just plugging large gaps in your carbon outcomes with carbon credits is not going to wash with regulators or the community, and it was never going to work anyways. Everybody going to buy credits? Well, guess what happens? The price of credits goes through the roof, and that becomes uneconomic. So, and of course, business is becoming directly accountable, as I said, both to the social and climate outcomes, and that's an impetus for change. And then finally, the capital markets. ESG funds now are obviously about 19 trillion. They're growing double digits. They're forecast to reach 34 trillion by 2026. That's nearly a quarter of global assets under management. It's a compound annual growth rate of nearly 13%. And that much money is going to, require and demand and define change. So, buckle up and get on with it.
That's great. So another question now for the whole panel, and personally, I'm interested. I know the audience is in hearing any valuable lessons from your career that your career journey has taught you. So, like, having navigated those economic cycles that we spoke about, and it's maybe, I hope it's not a jarring question, but I always find it an interesting one. What's your biggest regret, or something that you might have done differently with the benefit of hindsight? So let's start that one with Tanya.
Yeah, okay. I actually think, David, that the one thing that I could have done differently, and if I had my time again, I would, is I would have liked to have pursued sort of the innovation and the technology opportunities, as they became available. The property sector is notoriously slow to adopt tech and adopt innovation, and I think that could have actually made a huge difference to the sector. And I was in a position potentially to actually push it harder. The options these days include things like, property operations. We would all be aware, you can now have technology that's monitoring energy, water, waste, it's doing fault detection to Sim's point, energy efficiency, carbon emissions, all those sorts of things. So they're the traditional technology solutions that are available. But these days, tenant engagement, I think it's a really important technology initiative. It's a different offering. So tenants being connected to retail offerings, tenants being connected to, building services, tenants being connected to tenants. And of course, the revolution that's about to arrive is the flex space thing, where I think that being able to use space in multiple different ways is actually, there are going to be technology solutions that are solving for that are just, all over their agenda. So I would love to be, an early adopter and not an early follower, and think that, that would be a great thing to be able to play these days.
I think one comment is that the Australian property sector, I'm able to travel now and have offices in different locations, is a step ahead of everyone else. So I hear you when you say that the property sector is behind, but the Australian property sector, and I think the various sets of indexes all represent that, right? GRESB, the Dow Jones Sustainability Index, etc. The Australian firms tend to occupy the top tier of it. So there's so much room for tech. Paul, your hindsight, regret?
Yeah, I should have stopped believing in property cycles in about 2013, 14, when central banks started printing money and property values went into sort of an exo boom. Saw it, Macquarie Bank sort of built their property business through the 90s, just basically betting on lower for longer. And then this last cycle, you've seen Charter Hall and Goodman and the likes take investors into that same mode. And yeah, there's been some very, very strong returns through that phase just by being brave and not waiting, like there's the old man waiting for the property market to crash, right? So not waiting for the cycle to come. So yeah, that's probably my regret. Probably could have played harder. Having said that, being a pretty conservative guy, giving up on cycles means you've got to give up forever. So I'd probably still be buying now when rates are going the other way, and convincing myself that rates are going to, everything's going to go back, cap rates are going to go back to 2% or 3%, and interest rates are going to go back to 0, etc.
I know, I hear you. Mark, your hindsight?
Yeah, sure. Look, I think for me, when you're in a down cycle, it takes time to understand what's happening and to adjust. And, I think the 5 stages of grief definitely apply. So, taking that hindsight view, I have spent a lot less time in the denial, anger, bargaining and depression stages, and allocated most of my time to acceptance. And acceptance isn't about being passive, it's about learning from what's happened, reflecting on past similar episodes to get some insight, into what's likely to happen next, and then defining a strategy that will make the most of the current conditions, prepare for the eventual upturn, and go hard. And importantly, there's got to be key actions that will be taken sequentially to achieve the strategy and then execute them. So, doing that more quickly is really my my regret, I guess. And it's a bit like, when you have someone in the team that's not working out, you always look back and say it took too long to deal with that. Similar sort of thoughts. And of course, I think it's also a bit like flying a plane or coaching an elite sports team. You need data, you need a clear strategy, you need checklists, you need historic experiences, you need cutting edge technology, you need great people. And when you've got all that, I think you can navigate through anything, to be honest. And you've got to have zero politics, and you've got to have an environment where people will embrace direct and honest feedback and not defend against it. That in my book is the surest way to win, but it's actually really hard to get all that lined up and make it happen. Yeah.
That culture of openness and candid kind of communications is rare, but when you get it, it's great. Moving forward to today, Mark, and I will stay with you. If you were still an executive in a decision-making role for a real estate investment trust or a property group, and you had to narrow it down to 2 key areas of focus, what would they be?
Yeah, well, I guess I'm going to copy Tanya. So it's technology and innovation for me would be my primary focus, outside of obviously executing the corporate strategy mercilessly. I think that, and I thought this actually for decades, but all businesses, in my view, are technology companies to a large degree, but very few operate that way. I spoke earlier about real-time data and analytics, delivered in dashboards to enable better real-time decision-making. That's only possible when you've got integrated systems that obviously data sets talk to each other. They can be interrogated. Ideally, you're running in the cloud, so you can spin up and spin down your workloads seamlessly. You're obviously bulletproof, or as bulletproof as you can be from a a cyber point of view, and you're able to give people the data and the tools to win, in real time and make, good decisions, which ranges from everything to, what do you refurbish, what do you sell, what do you buy? How does that fit together into an integrated portfolio that operationally is optimized? And, even down to things like, what BMS sort of cohort am I going to use? How do my systems link in? What's my servicing and resetting schedule going to look like? And clearly there's a lot of pressure on premium. So, how are you going to do that? And something like a digital twin makes that, really easy, and you can actually do it and use AI to enhance your, day-to-day decision making, so everybody goes up the value chain. And you think about some of the curveballs that everyone's had to deal with, COVID and work from home, obviously massive variability in asset utilisation, massive increase in electricity prices, 40% plus increases in building costs, contractor failures, supply chain implosion, buildings that don't meet sustainability benchmarks, now virtually unlettable across the world, particularly in places like London and New York. That'll come to Australia. Victoria and the ACT banning gas connections to new homes. The negative read-throughs for legacy users are, I think, astounding. And thinking about the energy conversion process, you want to be able to model those things and then set a strategy and take a forward position to work out, how you're going to set contracts or reset assets. And then out of that type of information, I think, comes great innovation. And I certainly believe in the principle, innovate or die. So ultimately, if I just spoke to one example, quickly, I think modular building elements constructed to optimise sustainability could genuinely help solve the affordability challenge, for Australia. And FBR S is a good example. They've got a thing called Hadrian X. That's the world's most advanced construction robot. It delivers walls as a service, laying zero waste, pre-cut blocks. You get improved safety standards. You get 24/7 operations. You get 41 times faster laying of blocks than manual. You get reduced costs, about an 88% reduction in costs, and relative to manual labour. And so you can start to deliver homes as a service. And if we just work out how to rezone land and service it, you can then lay down dwellings at a much faster rate. So just, I think, a good example of how technology can redefine, and of course a whole new conversation's AI, but very exciting space, I think.
No, you're right. I mean, that quote around every company is either a software company or going to be affected by a software company is incredibly true. And I think it's the early adopters that tend to end up the winners. So Paul, the same kind of question to you around, I know you mentioned you're in non-executive director roles for a number of years, but if you were back in that C-suite role and had key areas to focus on, what levers would you be looking to pull?
Yeah, like I'm probably more macro than Mark. I sort of think about sort of the bigger strategic trends occupy my mind. So, the two that I'm interested in, one is, the future of the listed sector for property, and the other one's the role of super funds, and they might merge those themes. I think we've waxed and waned particularly every time there's a downturn about, whether real estate should be listed. Generally it only goes to the capital markets for funds when it's in trouble, which is not a great concept, and it's not always as liquid as investors like it to be. And the sort of constant drive for growth or comparative growth with the 200 or the 50 or the global indexes drives behaviour that's not really aligned with the way real estate should be managed. And I sit on some number of private boards, and we run private portfolios, and I've been involved with public companies, and it's always quite interesting because the public companies will drive for dividend distribution, whereas the private companies will go, well, if there's no cash flow or we want to retain cash flow, then we won't pay a dividend. So I find that interesting. The other one's sort of the role of super funds. those funds are just welling up now, not just in Australia but globally. But I think Australia now, something like 3.4 trillion, and it's going to keep growing at a sort of exponential rate. So I just, those funds will start playing a bigger role in the real estate sector. They haven't too much to date. I mean, we saw Aware Super take a piece of Altus as sort of a front end engine for their property play, but they're very light direct property. And even if they go to 5% direct property, it's going to change the shape of our world. And we might go back just to sort of remind everybody that I'm old, right? Back to when I first got into the property market in the 80s, all the big institutional property was owned by pension funds, a lot of them offshore. They were doing all the development. There was very little activity from, well, the REITs virtually didn't exist. You had a couple of Lend-Lease and Stockland and Mirvac were primarily developers.
Yeah, and that's awesome. Tanya?
Yeah, look,
back.
David, I'm going micro. So just because I can, there's a lot of, fascinating stuff that's going on in the property space at the moment. I'm thinking that, post-COVID, adapting spaces to better meet tenants' needs is just, it's one of those things that fascinates me. We've been through these cycles before where property workspace changes, but we're obviously on the cusp of a new one. I think that identifying, what the office offers that home doesn't is a really important question. And of course, we know that the answer is largely around sort of that personal connection. So we have to work out how to exploit the hell out of that. Statistically, I think we all know that jobs growth is in the blue collar sectors, and actually contraction has been in the, the traditional office sector, so the white collar sectors, so finance, tech, those sorts of areas. So demand for office is falling, but it's not uniform. At the moment, I think that it's the premium towers that are really under pressure, and what's happening is the middle market is actually sort of holding up quite well, which offers us a bit of a glimpse about, the changes that are likely to come. I think, we're shifting away from, high-rise towers probably to smaller, more human scale accommodation, that provides sort of a different kind of connection and a different kind of community. As far as I can tell, nobody is looking for 2,000 square metre floor plates, right? So what used to be, I mean, yesterday's sort of solution actually isn't going to cut it today. As far as I can tell, tenants are absolutely looking for sort of smaller, better connected, accommodation, and it's not necessarily in the CBD. So I think that there's a whole thing there that we need to understand and get our head around. And I'd love to be working in that space. If it wasn't there, I think that Mark's already touched on the area that I think is just going to be critical for where we're going. It's all about the circular economy in the property space in the future. I think that we've already worked out that bulldozing property is just not, that's just not an acceptable sort of behaviour any longer. We need to understand how to repurpose assets, and embracing sort of a low carbon future means that we're going to live within our means. Okay, we've got to work out how to upcycle, we work out how to recycle, we need to work out how to reuse. And so, actually starting the investment cycle with really the end in mind, how the building is actually going to be reused and how we can be, make it more versatile. To Mark's point, it will be about modular construction. It is about flexible space. And when you couple that with circular procurement, so it's all a part of this, live within our means thing. I think that the materials, I actually was in South Australia last week, and the South Australian government actually have a zero landfill by 2030 target. So, if you think about that, if we own an asset, there's no way in South Australia you can actually bulldoze that asset because you can't solve for the waste. And so what's happening in South Australia already is that construction waste and demolition waste is actually being taken from the site to recycle directly. So they're sort of cutting out the middleman, which is pretty impressive. You know, across Europe, there's some really, significant movement in terms of, building regulation. You actually have to be able to analyse the building footprint, the carbon footprint, before you can get a building permit in, countries like Denmark now. So I think that the circular economy it's a huge shift. It's going to make us think differently. We need to think differently. We think much longer term, and I'd like to do that.
Yeah. And it brings us into a question from the audience. I might hand it to you, Mark. It's, how do we expect the government's latest decision of allowing staff to work fully flexible will play out for owners and the markets, especially in somewhere like the ACT?
Yeah, I don't know that it's too far away from where things are in reality anyway. Most people, and I'll defer to Tanya and Paul, are a bit more in it, I guess, day to day than I am these days. But from what I can see and everyone I talk to, is that somewhere around 2 to 3 days at home, and the balance in the office is kind of where it's laid out. I think, like Tanya said as well, people are interested in flexible space outside of the home, but close to home. So you've seen more commercial solutions emerging around town centres and in some of the regional markets, and that seems to work for people, and fits in with their social as well as their, I guess, professional agenda. And if that creates happier, more productive, tied-in workers, actually there's probably some upside. There's a reason why we haven't seen great productivity gains in a lot of these economies, despite the massive improvements in technology, and that's simply this disengagement. You see it in most organisations. Up to 25 to 30% of people at any point in time are thinking about leaving. I mean, that's a serious problem. I mean, just contemplate what that means in terms of team morale, engagement, the idea of mentoring and training, and just going that extra mile, which is what makes the difference between winning and losing quite often. Then this stuff is very fundamental. And I think, no one likes me saying it. I sort of said it about 3 years ago, and I nearly got harpooned, but we're not going to ever go back to every day in the office. It's not going to happen. And flexibility is here to stay. And we really, organisations are going to be much more interested in trying to retain talented staff, because all the technology means that people are going further up the value chain. So they're becoming much more valuable to the organisation, and much, much more costly and difficult to replace than has ever been the case before. So I think ultimately no one's going to care too much where they are. They just want to make sure what they contribute and what the outcome is. But having said all that, I think you'll start to see the whole office demand side normalising and starting to grow from a new base of lower day-to-day utilisation. And as long as you don't build too much, it'll get back to a pretty healthy position. But it's going to take a number of years, and that's a long time, obviously.
Yeah, and it touches on another question from the audience in relation to how can we as an industry accelerate the creation of properties that are delivered and adapted for multiple uses, so we don't go down the unsustainable path of forever building office buildings that are largely only used for 3 of the 7 days in a week. So maybe I'll put that out. Whoever wants to grab that one.
Well, maybe before we answer that, I don't know. I got a feeling it's not going to keep trending the way it is, but then that's sort of tied into a view that something has to give. And I think as long as you've got 3.5% unemployment or 4% unemployment, then the employees will do as they please. But as Mark alluded to, productivity is down, and it feels like it's getting worse. I mean, I don't work full time. I spend a bit of time in the streets and the gym and the cafes and things. So I keep sort of echoing in my mind, you know, the Paul Keatingism, the recession we had to have. It sort of feels like we need some sort of circuit breaker. And I think when people realise that, you know, they need to be in the office, they need to be visible, they need to be training the new people that are coming on, that I think we'll see a sort of a reverse in the trend.
You know, David, I just thought I'd add, you know, with regard to your listener's question, we do have to start on that journey to solve for, you know, how property is used in the future. It's not sustainable for, you know, the CBD to actually be used 10 hours a day, 4 days a week. That's, I mean, I think that we sort of understand that is a problem. And so it means that we need to think completely differently about highest and best use, I think, for those towers. And, you know, so the councils and the state government and the territory governments are going to have to work with, you know, property companies to help us find a different way to use the accommodation, because the reality is that, you know, the city, particularly Sydney CBD, is absolutely dead, and that's just, you know, we just can't have it staying that way. So, you know, I think it has to be a collaborative approach. We all have to agree that, you know, there is a problem, and that we have to make, you know, some inroads to helping solve for it, and actually also understanding, you know, what good office looks like, as opposed to, you know, the offices that we have at the moment. Interestingly, you know, we know the tenants are actually paying more per square metre, but actually buying less square metres. So there's, you know, some signals there about what we've actually got to do. But we're going to have to do it in collaboration, because all of the, you know, the planning rules and the structures are just not going to allow us to solve what is a really big, you know, that's a big sustainability problem.
I just pick up on Tanya's point too. You look at the most dynamic cities or spaces, you know, they're mixed use for real. And, you know, it was only probably 12 years ago Sydney was dead on the weekends before residential came to town. You know, the idea that planning restricts, you know, residential as tightly as it does is a great example where it doesn't have to be that way, you know, where it would open up some incremental conversion opportunities. It would, you know, change the utilisation of some of those buildings that Tanya talked about, and it would create a much more dynamic environment, not just for working but for living, and that combination is really what people are looking for. And it's, you know, I always think of a city like Tokyo, where you go into a building and it's like, whatever the percentage, I'm sure I'll be off, but like might be 15% traditional retail, might be 15% restaurants and food, it might be, you know, another X% hotels and serviced offices, and then some traditional office, and then resident apartments, and it's all in the same stack. I don't know how they get around the plumbing issues and some of that, but you know, those buildings, you know, really, really work hard, and people love them.
Yeah. No, look, and I think we're kind of touching on to, we've touched on learnings from the past, and then what you folks would do if you were back in the C-suite. And now these things are very much around that, looking ahead in future, these kind of latest just remarks and comments you've made. But in relation to the economic cycles, what are your thoughts on where they're heading for the next 12 to 24 months? Maybe to you, Paul.
You're going to start with a bear, all right? Won't surprise anybody probably to hear that I'm bearish. I'm just not sure whether I'm a grizzly bear or a teddy bear. I think that, I mean, I'm out in the market, there's sort of two schools of thought. There's those probably like me that are expecting, you know, this cycle to run out, and that interest rates will either, they'll either be pushed hard enough to sort of try and or knock inflation out totally, which will probably cause a recession, or the Reserve Bank, and not just the Reserve, the central banks around the world, because they're facing the same issues, will pull back. But again, sort of going back 70s and 80s, you know, we lived 2 decades with, you know, 5 to 7% inflation, 5 to 7% interest rates, and it took a massive sledgehammer in the late 80s, early 90s to stop that cycle. So the teddy bear in me says that the government, to the extent that it can control that, and the central banks will probably pull back short of recession. I don't think it'll be enough. I think there's some serious wage inflation coming through. So, yeah, bearish. The flip side is, there's still, for every one of me, there's another person that's going, look, everything's fine. We'll beat inflation in the next 3 or 4 months, and interest rates will go back to 2%. Cap rates will come back down, and off we go again. So nobody knows, but I'd be betting on like flat to down for the next 12 to 24 months for the markets.
Okay. And Tanya?
Yeah, look, I'm not sure whether I'm grizzly either. I was listening to actually it was a JLL economic report just recently, and their theory is that Melbourne vacancy is actually running at 20% at the moment. That's an all-time high, and it's an absolutely scary number. And so, Paul mentioned earlier, property cycles are sort of 7 to 8 years, but JLL are calling a 13-year cycle. So if it's actually a much longer cycle than we've seen, and I've got no idea whether they're right or not, but if it is, it means that we need to start looking at things differently, start thinking about things differently, starting to find different opportunities. And as we were sort of touching on before, we also need to be looking longer term and solving for these bigger picture problems while we're in this while we're in what is a relatively long, flat and painful period, I think.
Yeah, and Mark, you obviously having in that global head of real estate and research role and with UBS, what are your thoughts?
Yeah, well, it's complicated, that's for sure. But I think if you're looking at that time frame, I think it'll be still reasonably challenging. Let's call it challenging, or to weakish for the balance of this year. I think beyond that, I think it's moderately up. And certainly, I'm not in the camp of we get back to 2% interest rates or anything like that, but certainly moderately up on the basis that unemployment is historically low. Interest rates, clearly I think close to peaking if they haven't already, and inflation in everything really except wages is moderating, and wages always lag. It takes a while for that to get going. I mean, there is a risk that it's getting ingrained, but looking at the intention surveys and what's happening outside of some of the the union negotiations, it would suggest that it's already starting to moderate back down to somewhere around 3%. Migration's obviously a big part of this as well. It's returned, I think, more rapidly than anybody expected, and it's causing its own short-term pressures, particularly in the housing market. But we look like we'll meet the 235,000 plus permanent migrants, temporary migrants, which are primarily students, back to pre-COVID levels, nearly 2 million in the country now. So, that's a pretty solid underpinning, and certainly points to increasing demand in most property sectors. And I think the risks really are geopolitical. Is China going to be able to stimulate effectively? And history would say yes, and they've certainly got plenty of firepower for it. They just don't seem to have the policy wherewithal right now, but that's probably because they're still trying to wrench out some of the excesses, and obviously there's plenty of other geopolitical hotspots going on that could also come out of left field. But, I think overall I'm not in the bearish camp. Yeah.
Okay. And in relation to the opportunities that exist within commercial property investment, like where do you see those opportunities, and how would you balance these opportunities with and communicate the opportunity to investors? Maybe stay with you, Mark, on that one.
Yeah, well, it's certainly had an amazing run, so I feel a little bit nervous saying this, but it's really hard to go past logistics, to be honest. I mean, the migration I just talked about and the growth rate and in natural birth rate and where unemployment is, you're going to continue to see pretty robust demand as it relates to consumption and the requirement around storage and moving goods around. And the process of nearshoring and onshoring to try and shore up supply chains, that takes years to reset. So that's an ongoing incremental pressure point. And then, of course, the ongoing gradual increase in online. So if you look at the latest Deloitte forecast, by 2025, they're saying there'll be an extra 1.2 million people, which I think is probably conservative. That equates to 1.3 million square metres of incremental demand for industrial and logistics space per annum. That's over 80% of the new supply delivered in the last decade, and we're not delivering anywhere near that beyond the current sort of higher levels that are sort of flowing through, and there's been a lot of delays there as well. So bottom line, you've got a chronic undersupply and pretty strong demand, and vacancies obviously 0.6% at the moment, the lowest I think in recorded history, and pretty modest levels of speculative development, more than 50 billion of capital chasing it, and not much zone service land around. I mean, look at Sydney, probably be out of service logistics land within 5 years without a change in strategy around roads in particular and other enabling infrastructure. So that's a very strong set of fundamentals right there. And then I think premium in the other sectors, sort of particularly retail's been much aligned, but it's actually performed a lot better than most people predicted. And I think it'll probably keep sort of trundling along.
Yeah, correct. So a final question, and kind of a takeaway for the audience. We've obviously an audience of property professionals on this webinar, and if you wanted them to remember one lesson from your experience, what would it be? I'll start with you, Tanya.
Look, David, it's a really quick answer for me. I just think it's measure what matters. In my whole career, the biggest challenge that we have is that there are so many things that need to be done. There are so many opportunities in front of us. Somehow you actually have to make a decision what's going to move the needle. So, somehow we absolutely have to work out how to prioritize. And then once we've actually decided what that is, it's find a way to measure it, because that will actually get us there. So, whether this is sort of the South Australian government saying we're going to have zero, waste to landfill by 2030, or whether it's the federal government coming out this time with their new plan saying we're going to be, net zero in whatever area by 2035 or 2045. We need to know what it is that's actually going to make the difference, and just, measure what matters. So that's
fantastic.
That's my thing.
Yeah, I love it. Paul?
Yeah, again, macro theme. Look, sentiment and human nature tends to drive, once you get past the property fundamentals, will drive property values up and they'll drive it down. So my message would be, don't believe lower for longer all the time, or for that matter, higher for longer. So I'll leave you with that.
Yeah, thank you. And Mark, your one lesson for everyone?
Yeah. Well, I think just always be an optimistic realist. Is what's said for that. I absolutely agree with Tanya's point about measuring what matters. Clearly define your plan, your strategy, and obviously you have an action list that runs off what you're measuring. Hold people accountable to deliver it.
Yep. Look, folks, I think we'll just close it out there. We have just 5 minutes to go on it. So thank you very much to the panel. I really enjoyed listening to the experience and the insights. And thank you for everyone that's dialed in and taking the time to listen to us. There is a short survey that we encourage you to complete just after this webinar. It does help us to ensure the feedback so that we're able to bring as much value, and I wish you well, and we look forward to seeing you at our next event. Thank you very much.
Thanks, Dave.
Thanks.